Employee ownership trust rules are changing in the UK. Following a government consultation in 2023, several of the changes to the EOT rules were announced following the October budget. The government wants to ensure that the EOT exit route continues to benefit those who use it for its intended purposes, but they also want to make sure that the EOTs are not being misused due to their fantastic tax benefits. Firstly, effective immediately, former company owners can no longer retain control of the EOT after the sale, including through any powers listed in the trust deed. They can stay on the board of trustees, but they cannot have control over it. This includes anyone closely connected to the former owners, such as spouses or children. It was also announced that the trustees of an EOT must be UK resident for the disposal to qualify for the tax relief. If this condition isn't met, the EOT will lose its status and exit charge will be triggered. However, if the EOT's settler was a UK resident when it was created, it can still have a mix of UK and non-UK resident trustees. Next, when a company contributes the money up to the EOT to pay former owners for their shares, this is to be classified as a distribution. A new tax relief, however, will ensure that income tax is not charged on these distributions. The government has also made it easy for companies to give employees tax-free bonuses, with directors now excluded. However, there are no plans to increase the tax-free bonus amount of £3,600 per year. The government is now also extending the vendor clawback period for EOTs from a maximum of 2 years to a maximum of 4 years. This is the period in which it may recover taxes from the former owners of the business if the EOT qualifying rules are broken after the sale. To qualify for relief, trustees must now clearly demonstrate that the price they paid for the shares does not exceed the fair market value at the time of the disposal. This is to prevent former owners from inflating their share value to take unfair advantage of the EOT. Finally, if you sell to an EOT, you will now need to provide extra information to HMRC in your self-assessment tax return to claim the tax relief. From the 24-25 tax year, you will now need to disclose the consideration you have received for the shares, as well as the number of the employees the company had at the time of the disposal. For a full list of all the changes announced, including some changes relating to the employee benefit trusts, you can read the government's full consultation paper online. At Shorts, our view on these changes is that the business owners considering a sale to an EOT shouldn't be overly concerned by them. The changes are largely aimed at stopping EOTs being undertaken for the wrong reasons. Our team has significant experience in undertaking EOTs, having completed over 20 in the last few years, and our existing processes already deal with the majority of these changes. We believe strongly that for the right business and owners, an EOT is still a great way to sell your business, and certainly the most tax efficient. However, tax efficiency should not be the only benefit. The EOT route presents huge benefits for both the business and its employees, as well as the exiting shareholders. Our advice will always be to do an EOT for the right reasons, and to choose an experienced advisor who can guide you through the whole process and help you navigate these recent rule changes. If you are considering an EOT, it's always important to take the time to review all of your exit options carefully with the help of a qualified advisor. If you would like to learn more about EOTs, you can visit shorts.uk.com/EOT.